Brad Williams, Frugal Finance, the Purchasing Power Parity theorem. The Purchasing Power Parity theorem asserts that the exchange rates between two currencies must be proportional to the price level of traded goods in the two currencies. The PPP theorem is intimately tied to interest rate parity. As we discuss later, violations of the PPP theorem can lead to arbitrage opportunities, such as the following example of tortilla arbitrage. You're going, tortilla arbitrage? Yeah, this is just a very simple example. But for tortilla arbitrage, we assume that transportation and transaction costs are zero. You just go with this, okay? This is not a realistic expectation, but the notion of understanding arbitrage, this is a good example. So assuming that transportation and transaction costs are zero and that there are no trade barriers such as quotas or tariffs, these assumptions are essentially equivalent to our usual assumption of perfect markets. The spot rate value of the Mexican peso is 10 cents. And the cost of a tortilla in Mexico City is MP1. That's a Mexican peso 1 as shown here. In New York, our tortilla sells for 15 cents. So this price creates an arbitrage opportunity. A trader can exploit this opportunity by transacting as shown in the bottom portion of table 9.6. Given the other values, price for tortilla in New York must be 10 cents to exclude arbitrage. Well, it's pretty simple. You buy $1 million worth of tortillas for 10 cents in Mexico, and then you sell the same tortilla in New York City for 15 cents. So it doesn't seem like much, but a nickel times a million is, well, it's risk-free, unless your tortillas go bad. Here we go, New York City. This should be Mexico City. This should be 1. Let's see if that blows this thing up. It does. My math is probably wrong. Mexican peso, you pay MP1. Here, you're going to pay 10 cents. This is just 0.19. Don't worry about it. You buy 10 tortillas in Mexico City for $1, and then you sell 10 tortillas in New York for $1.50, and you make 50 cents. Over time, exchange rates must also conform to PPP theorem. The left column of table 9.7 presents prices and exchange rates consistent with the PP theorem at time is equal to 0. The right column shows values 1 year later at t equals 1 after a year of inflation in Mexico and the US. During this time, Mexican inflation was 20%, so a tortilla now sells for 1.2. In the US, inflation was 10%, so a tortilla now sells for 11 cents. To be consistent with the PP theorem, the exchange rates must also have adjusted to keep the relative value of the euro and dollar consistent with the relative purchasing power. This should say peso. The peso and a dollar consistent with the relative purchasing power of the two currencies. As a consequence, the dollar must now be worth MP 1091. Any other exchange rate would create an arbitrage opportunity. Requirements that the PPP theorem holds at all times means that exchange rates must change proportionally to the relative price levels in the two currencies. This is true throughout the world. If it's not, somebody will take advantage of it. So if you think 10% rate in Japan versus a 3% rate in US is advantageous, do the math. Go back to the very first session here in currency, and I showed it. My explanation may have sucked, but the numbers don't. Otherwise, arbitrage exists. Basically, this would be a free transaction. If you can somehow get the number of tortillas into the US without having to pay any kind of travel. In other words, if you're already going down to Mexico, you go to Mexico to see family members every year, it's a sunk cost. If by chance you are buying a bunch of tortillas in Mexico on your way back, you fix that travel issue. Anything you do in terms of selling in New York City is pure arbitrage, other than maybe you being held up. That's one way to avoid, not worry about the cost of transportation. Purchasing power and interest rate parity, the intimate relationship that exists between the purchasing power parity and the interest rate parity theorem originates from the link between interest rates and inflation rates. According to the analysis of Irving Fisher, the nominal or market rate of interest consists of two elements, the real rate of interest and the expected inflation rate. Didn't I talk about this earlier, about inflation? This relationship can be expressed mathematically as follows. This should look really familiar. Where N reflects the nominal interest rate, R with a star reflects the real rate of interest, and E of I, the expected inflation rate over the time period in this example. Since the expected inflation is the expected change in purchasing power, the PPP theorem expresses the linkage between exchange rates and relative inflation rates. The difference in nominal interest rates between two countries is likely due to differences in expected inflation. Remember that. You're going to be asked this question from time to time. Why are interest rates at 15% in Brazil and 5% in the US? You can say it's political or it's some other reason. It's going to be expected inflation. Expected inflation. Just keep that in mind. This means that interest rates, exchange rates, price levels, and foreign exchange rates form an integrated system. Brad Williams, Frugal Finance. See you soon.